Mark, you mentioned debt ratios, and that's something we haven't talked about yet. So there are obviously debt ratios that fit within certain standards and things like that. Could you talk about that and maybe how people
Sure.
can help maybe calculate their own debt ratio as they're thinking about
Sure.
getting ready to buy a house? Because maybe they have a little extra money that they could pay off that extra credit card that's maybe impacting their debt ratio.
Sure. So there's basically what debt ratios are is your mortgage payment plus whatever reported consumer debt you have as a percentage of your gross monthly income. So to keep it simple, let's say you earn $120,000 a year, okay, which means you're making $10,000 a month. Let's say the house you're looking at, the mortgage payment is going to be $2,000 a month, including principal, interest, taxes, and insurance. Okay, and you've got a car payment for $500 a month, so now you're up to $2,500, and you've got a student loan that's $100 a month, right? So now you're up to $2,600, and you've got various credit cards that total $200 a month. So now you're up to $2,800 a month. That is 28% of your gross monthly income. You will qualify for that loan based on your income, okay, that you're applying for with those debt ratios. The magic number is really 45.
Okay.
They can go as high as 50. If you don't have some other contributing factor, if you're looking at a debt ratio of 45, then you should not buy the house. In other words, you have fantastic reserves. Your mother-in-law is going to live with you and contribute to the household. You know, you have a wife with, or a spouse, a husband with bad credit, and they're not going on the mortgage because their credit would not allow you to purchase the home, but they contribute to the household, then it's fine. But if you're a single guy who's 25 years old and you're looking at a 45 debt ratio, you're not going to have a life.
Yeah. Yeah, you're going to end up what they call house poor, right?
Correct.
Take that same
Correct.
situation. Now the income is $50,000 a year, right? Or income's $5,000 a month, let's say. So that's $60,000 a year. That
Right.
same debt situation would put them over 50%, and they would not qualify for that
Correct.
home, right?
Correct. Correct. And
Well-
sometimes we have a situation where a guy is buying a condo and he's bringing two of his buddies and his roommates, and they're going to share the expenses. That's completely different.
Right.
By the way, guidelines do allow us to count some of what we call border income, but I have yet to see an investor that will actually count border income for qualifying purposes. So just because it's in the guideline does not necessarily mean that an investor will consider that when qualifying you for a loan.
Right. Yeah. So another thing to think about is, oh, but I have these other things. That does not guarantee that somebody's
Right.
actually going to say, okay, here's the money,
Correct.
so that you can go purchase that property.
Correct. And people think if they go to a local savings bank, they're going to be more flexible. Actually, that's not true because the OCC, the Office of the Controller of the Currency, which regulates federally chartered community banks, and most of them are federally chartered, not state chartered, they come in and make loan level decisions for these guys. They say, you can't do this and you can do that. Even if historically they've done a certain kind of lending for years, the OCC has now told them they can't do that anymore, even though it may be good for their community. Mm-hmm. I've seen it before. So yeah. It is what it is.
That's good information.